No, not necessary. I'm just gonna quickly introduce you guys. And thank you, Danny, and good evening, everyone. First time I've ever said good evening when speaking to a group of people. But my name is Tope Awani, as Danny mentioned. Been with Calamos Investments, which is based out of Naperville, Illinois, since 2010. In the industry overall for over 15 years. Calamos Investments, for many of you who aren't familiar, manages just approximately $30 billion in assets across several open-end mutual funds, 7 closed-end funds, and also institutional assets as well too. So our guest speakers today is people that I am pleased to introduce to you, and bear with me here. Let me change my screen. Okay, so with me today, Michael Klenn. Michael is a CFA. Michael joined Calamos Investments in 2019 following the acquisition that Calamos made with Timpani Capital Management, his employer since 2010. Prior to that, Michael was a member of the Applied Investment Management program at Marquette University, running a portion of their endowment. He received his undergrad in finance from Marquette University. And Michael serves as a senior research analyst for the Timpani Small-Cap Growth Fund, along with the Timpani Mid-Cap Growth Strategy. Kyle also joined Calamos Investments in 2019. He is also a research analyst.
Tengo que tomar a las... O cuando sea, ahorita esa alarma que escuchaste, no sé si escuchaste esa alarma, esa es para que tome mis pastillas, entonces ahorita tomé.
Okay, we got some...
yeah, I'm trying to mute them.
No worries, no worries. So as I mentioned, Kyle is a research analyst alongside with Michael for Timpani. He joined Timpani in 2017. Prior to that, Kyle served as a mutual fund administrator. Kyle served as a mutual fund administrator at U.S. Bancorp Fund Services. He received his undergrad in business management with a concentration in finance, as well as an undergrad in marketing from the University of Wisconsin, Parkside. And pleased to turn it over to the team to kind of go through the deck, and then from there, I believe we're going to take Q&A.
Okay. Great. I'll just jump into it. I don't really have anything else to add on my background. Maybe the only thing I do a lot of our healthcare. Kyle's been working on tech and industrials, but for the most part, we still say we're generalists. We look at anything, and you know that's how we split up our team. Let's see. So as Toby said, we're on the small and mid-cap growth team. And we try to exploit some behavioral biases that exist in the market. First one we have listed here is the disposition effect. Investors' preference for avoiding losses over earning profits leads them to sell winners too early and ride losers too long. You've seen that a lot this year. If you think of the tech stocks, the work from home stocks, those stocks have gone up for a lot longer than some people probably think or thought would have happened. And things like banks, some of those more industrial names, material names, very heavy cyclical names have underperformed for a lot longer than people think. So it's been a very good year to be trying to take advantage of that behavioral bias. And the other one is the anchoring bias. Analysts tend to be slow to react to new data points, where we try to be quicker to react to new data points. A big example of this was, if you think back to earlier in the year, companies reported Q1 earnings towards the end of April when basically the world was at a standstill. and numbers got published at the bottom of the coronavirus pandemic. And as things improved throughout the quarter, they didn't update numbers. It's just how the sell side technically works. And comes out, a lot of the companies report Q2, report big beats because the estimates were anchored to the bottom, didn't get updated to include, the improvement through May and June. Now, a lot of the stocks were already up and reflected that, but, when you saw the Q2 earnings reports and it was basically every company beating, this is why. So the other thing we're trying to do is we're trying to find companies where we think there's a positive growth gap. And simple way to think of it is we're trying to find companies that can beat and raise, that are going to grow faster than the current market expectations. And we use the consensus expectations from the sell side as the proxy for the market expectations. So ideally, we want to find a company that's growing, that everybody else thinks is growing 15%, and we think it can grow 20%. And usually when that happens, you get multiple expansion on top of that. So if, to just use some other numbers, say if a stock, the earnings estimate for this year is $1 in earnings, it's going to get a 20 times multiple, be a $20 stock. Let's say the real number is going to be more like 150, and the multiple is going to re-rate to 30 times instead of that 20 times. So now instead of just getting the 50% upside you got from EPS, you get this multiplier because the multiple expands. And now that $20 stock went to 45. So we're trying to find this over and over and over again, and we try to populate the portfolio with names like this and or with situations like that. And then on the opposite end, when we see that perception gap is closing, that's when we're looking to get out, because the reverse will happen. Estimates will get cut, and they need to get cut and cut and cut, and the multiple comes down, and that $45 stock goes back down to 20. And it, there's not a valuation level. It's not, we own things that are multiples of sales. We own things that, don't even have revenues yet. Those are maybe some more unique circumstances, but just because something, we don't use price targets, we think that's a bad recipe, garbage in, garbage out. You think what the market is willing to pay for a certain stock, and you could be wrong, right? So we try to not say we're smarter than the market. We try to listen to what the market is telling us, and we react from there. Kyle, do you have anything to add to that?
No, I think you hit the head.
Okay. So this is how we go about our idea generation. It usually come from three main areas. We have database screens that we run. The majority of the screens that we use come from the William O'Neill software. It's called Wanda. There's also a newer version called Panarray. And then we meet with companies. I don't know, Kyle, you had a couple meetings today? I had a couple meetings today, more tomorrow. We're constantly meeting with companies, talking to the management teams, and trying to, if I go back, trying to figure out where they are on this curve. They can say, we ask them, what's the market growing at? Are they taking share? Or are they losing share? That's a quick way to get to a top line revenue growth number. If the market's growing 20% and they're taking share, but the analysts are only modeling 20, there's a gap there. And if they're not taking share, why aren't they taking share? So that's another. And then the third would be industry contacts. We work with the sell side, firms like Goldman Sachs, William Blair, talking to their analysts, attending their conferences, even though they're all virtual now, and trying to find new ideas from that. So a lot of them come, we used to put them into buckets. Okay, this idea came from the screens, this was from industry contacts, this was from company meetings, but the way this wheel is set up is a much more accurate picture of how it works, because just because something shows up on the screens, we don't just blindly buy it. Then our research process goes into motion, or it's, hey, we've met with this company before, and now it's showing up on the screens. So, we're ready to act because of the research we've already done. And so you can just see some of the numbers here on the right. There's roughly, 1,500 stocks to pick from, but not all of them fit our criteria, which we'll get into later. So some people say, well, you only have a team of 4 people, how can you handle all of it? Well, a lot of them don't fit what we look for. And we try to keep the bar high for what's going to get into the portfolio. And it usually ends up, at a list of 80 to 120 stocks, probably a little on the high end right now because, the market's been strong. Secular growth is working, and we're just trying to make room in the portfolio for all these good ideas we're finding. So we call these the tier 1 criteria. And a lot of times when we're talking internally, we'll say, hey, this is checking the 3 boxes. So the 3 boxes for us, the first one is sustainable growth. So is the growth we're seeing today sustainable? We don't want a company that's just going to grow 20% for the next quarter or the next 2 quarters. We're looking to find companies that can grow 20% plus for the next 10 years. So by doing that, we look at the size of the market, the competitive landscape, their ability to fund the growth, and the product pipeline. We normally say, like 10% on the top line, 15% on the bottom is loose thresholds. But there's always exceptions to that. And if anything, we tend to be a little higher than that. But that's probably the least unique box for us. If you're a small cap growth manager and you don't have something like this, you should probably be in a different category. The second box is underestimated growth. So we care because otherwise, we don't want to own a company that's growing 40% that everybody already knows is growing 40%, or a company that's growing 40% or that people think is growing 40% and actually going to grow 38. Like that's, either there's no gap or it's a negative perception gap. We'd rather own something that's people think is growing 15% and is going to grow 20%. So, we talk to the analysts and go through their estimates. We talk to management. We ask them, how are they compensated? Are you incentivized to beat your guidance or to beat the consensus expectations? Is your bonus capped at all? Right? Because if it is, you're going to hold back upside. We don't want that. We don't want that structure for us. We don't want that structure for the management team. We want them to be able to go for it and to put up the best numbers they can at all times. And some people get it and some people don't. And, we'll say in our notes to each other, hey, I don't think this checks the second box. This sounds like a good growth story, but, they don't get it. They don't care what the analysts think. They don't care what the rest of the world thinks, they should be growing at. They're just going to do their thing. And that's not a good fit for us. And that's okay, because again, there's 1,500 stocks, to pick from, and we're narrowing it down. We need some way to narrow it down. I tell Kyle all the time, like saying no to a stock is still, it was worth your time. Like we know that doesn't fit. We can move on. We can find the next one. And the last box is market sentiment. So is the market confirming our fundamental conclusions? Will it play out in a timely manner? We use technicals. We look at moving averages, relative strength, volume trends, and we're not shy about it. That's part of our process. And, there's an opportunity cost to own in any stock. We don't want to own something that we think is dead money for 6 months because we think we're good at this and we can find a better place to put our clients' money for the next 6 months, and we can come back to it. We have, watch lists and ways to do that pretty easily. So, those last 2 are more unique to us for sure. Like I said, the first one is really kind of any growth manager has it, but adding the second and third box is how we differentiate from other small and mid-cap growth managers.
I would just add, like our screens are built around that process too. So if we're not going to disclose kind of everything that's within our screens, but estimate revisions, sustainable growth, are they growing above 10%? Market sentiment, are they above the 50-day moving average? Are they above a 80 score and a William O'Neill on a relative strength for market sentiment? So we're kind of we're whittling it down to get to those narratives, if you will, and then we discuss with the analysts and the management teams, and that's kind of how we get down to, I don't know, what would you say, Mike, on average 10 to 15 stocks a week between the 4 of us would kind of be we're looking at newer names that we haven't looked into before. Maybe it's an older name that we owned 2 to 3 years ago that hey, it didn't work out last time, but maybe there's a new management team in there. They have a new product. They have a new strategy, go-to-market strategy, something along those lines that can get us excited again. So just wanted to kind of fold that all back in together.
Yeah, and maybe just one other point on the screens. We, every stock gets a score of 0 to 100, and then we went back and looked at, okay, what scores perform well. So I think, well, it's tough for me to say because I've never worked anywhere else, but I think some people just, they run their screens and that's what they believe, and they don't actually check and see, like, is this a good screen? Does it work? We are diligent about that. We are constantly updating that analysis. And if all of a sudden that wasn't the right pond to be fishing in, we'd find something else. And we'd go to a different one. We have a couple different screens that we run. So, and we're, again, doing that same analysis on all of them. Are they finding big winning stocks? Are they finding stocks that outperform? And through the entire time I've been here, the answer has been yes. And it's been a pretty consistent yes. And that's why we keep using them.
And what's key also with screening that a lot of people don't look at is the batting average. People look at the just simple average of the stocks, and maybe a better metric would be a median as well as a average and as well as a batting average specifically. If you can get a batting average of something north of 55%, the best investors in the world are, batting 55, maybe 60% on their stocks. And nobody wants to look at it that way, but it's not the easiest career path in the world to be successful at, right? And so, as Mike was saying, it's something that is critical and that you need to continuously monitor, and we monitor it weekly. And like, are these screens actually doing what they're supposed to be doing? And they certainly have been for the last 10 years, Mike? I mean, and before that, probably 15 years. So,
yeah. So all of this leads to how do we eventually build the portfolio? And I'm sure you guys hear a lot about ETFs and passive investing. If that's what you want, you're not looking at us, because that's not how we do things. We are trying to find stocks that can outperform the market, and we're trying to find those every day. Through a combination of those three boxes that we talked about, and some of the risk management things we have in place. We avoid stocks with lumpy businesses quarter to quarter. If you have maybe a semiconductor equipment company, you have high ASPs, and the revenue recognition maybe isn't always up to you, right? It's when the customer accepts the order. And whether that order gets accepted September 30th or October 1st doesn't matter to the company, but it matters to investors, because then it looks like you missed the expectations. And so we're aware of that. And we, again, we try to avoid those companies, or if, it's checking every other box, and, it'll be a lower weight in the portfolio. And something else that, can often go along with that is significant customer concentration. Not to say we avoid that at all costs, but if you have a customer that's 50% of your revenue and they say, hey, we don't need any this quarter, or we're leaving forever, that's going to impact the stock quite a bit. So we try, again, to avoid those situations, as well as binary events. A lot of biotech. It's not a great fit for our process, but it's taken a big step up in the benchmark. So we do have some exposure there. And, we prefer companies that are making money. So as you see at the bottom, losses or high leverage. I think it's probably a bigger deal to other investors. And because of that, we know it'll never get maybe the multiple that we think it would deserve. So that's part of the reason we avoid those. Some of these other things on the right, those are just hard limits set up by compliance, to make sure we're not getting too out over our skis in any one sector or any one position. There's another slide just showing, when we say, if you want an ETF, we're not the investment for you. This is kind of how we can back that up with data. So you can see our active share is pretty consistently over 80%, relative to the benchmark. And we do look at the benchmark. We own some of the big names in there, but we don't own all of them. Just because it's a big weighting in the benchmark doesn't mean we're going to own it. It needs to check our boxes too. And then we decide, to go from there.
Hey,
A little
Mike.
more our risk management, it's pretty clear right at the top there. We don't fall in love with stocks. We're not married to these things. If it's not checking those boxes anymore, we're reducing exposure or we're moving on and finding something else. That's why we always have this, kind of database of 150 to 200 that could be in the portfolio, and they're not all in at any time. So if something's moving out, something else can be moving in, or we can sit on the cash for a little bit until we find something that that makes sense. And the sell triggers for us, again, it's not a price target. It's violating one of those boxes that we talked about before. The growth rate comes into question. They're missing earnings, revenues and earnings are getting revised down, or just, the moving averages are rolling over, relative strength is weakening. We like to say, like, somebody knows something. Stocks just don't sell off for no reason. So that's why we pay attention to those things. Anything to add, Kyle?
Nope.
Okay.
Hey, Mike, I got a quick
Sure.
point. Can you go quickly back to that active share slide? And I'm not sure if many of the folks here understand the study that was conducted years ago on active share. Can you quickly explain what you mean by that?
Yeah. All right, well, Kyle, how familiar are you with this? Because
So yeah, active share is just essentially saying what do you own that the benchmark doesn't own. So if we own 100 stocks in the portfolio, the benchmark owns roughly
for the weight,
1,200, I think. Yeah, and they own, let's call it 20, 40% of their index, then that would be like 60% active share, I believe is how the calculation works. So essentially the higher active share you have, and as you can see, we're in that above 80 box, that means we have a higher tracking error, and so we'll have more volatility or more, maybe that's not the correct way to think about it, but we have a better chance of performing better or worse than the index because we just have less overlap with the index.
right. It's a way to measure how like or unlike the benchmark. Yeah. Like, as you can see, 90, almost 80+% of our portfolio does not overlap with the index. So, if you just want index returns, again, we're not the place for you. We're trying to outperform. But that, the risk comes along with that. There are times when the boxes that I talked about before are not in favor, and the market is not embracing the same things that we look for. And, that's a time when we'll struggle, but there's enough, I think, historical evidence that this works over time. You just kind of need to stick with it and ride it out.
Yeah, and I would add too that in our industry, in the asset management industry today, fee compression is a major factor that managers have to consider, because when you're able to display a north of 80% active share, you're able to really justify your fees. So that's something that is not going to go away. And as you guys enter the asset management world, this is definitely a factor that's critical when you're looking at actively managed portfolios versus passive. So thank you, Mike.
Yep. Keep going. We're good. Okay. So this is just a little more on the sell discipline. And, so kind of, if you think about some of the comments I had on our screens, like, we don't just run the screens and then just be like, okay, great. Like, let's see, we'll just follow these screens. We used to get asked about our sell discipline, and then it was like, well, why don't we just run the numbers? So this looks at the final sale of every stock from the portfolio and how does it actually perform versus the benchmark in the 1 month, 3 months, 6 months, and 12 months after that. And so you can see down at the bottom, stocks that we sell from the portfolio persist as losers after that, underperforming by 1,000 basis points at the median. And, we have every year on there. I mean, some years are better than others, but at 12 months, every one of them is negative. And even at 6 months, the ones that are positive are barely positive. So, we do a good job getting out of the way And if you think back to one of the first points, some people want to dig in and they want to hold on to their losers. We're the ones selling the losers, and we have the data here to back it up that you should be selling the losers. So we do have some themes in the portfolio. We have a couple stock examples we can talk about later. But if you think some of the points that I was talking about, what we're looking for, growth areas, we're looking for secular growth. That's what we do mostly. We don't want something that's just growing at GDP or growing because GDP's coming around, or interest rate plays or things like that. We want something that can grow that 10 to 15% in any kind of environment. And it's not easy to do that. We understand that. We have a high threshold to be in the portfolio. But some of these companies, I'm sure you guys are familiar with, Teladoc, obviously huge winner this year, big growth. They're growing through the pandemic, right? This was great for them. And not that that's why we owned it. We owned it before all this. This just accelerated some of the trends that we already had in place. And that's probably a common theme with a lot of these companies on here. We owned them before COVID hit, and COVID accelerated the trends that they were already participating on. 5.9, Ring Central, bandwidth specifically. But we don't just ignore the cyclical areas. I mean, if you look, we've owned the boating stocks. Is people couldn't go on vacation, they were looking to buy boats, they were looking to buy RVs. We were pretty early on that. I think Kyle would agree with that. As my dog's trying to get in the picture here. And so it's a mix of secular and cyclical. But I think at any point the tilt is always going to be towards secular. You're never going to see 80-90% of our portfolio in cyclical growth names. That's just not really how we operate. And they don't grow at the rates, to check the boxes that we're looking for usually.
And secular and sustainable are somewhat synonymous in themselves, right? To be a sustainable grower over 5 to 10 years, you have to have some sort of secular market tailwind, whether it's e-commerce or any of those kind of themes, excluding kind of the boating theme. But you've seen it with Amazon, you've seen all the large cap tech stocks. There was a secular theme that's been going on for 20 years, and to ignore that and to dig into cyclical stocks and try to play that game is just not something we'll do for long periods of time.
So here's just kind of this quick overview. These are the weightings at the end of Q2. I guess the one thing I would call out here is typically within small cap growth, the big areas are those top three: healthcare, consumer, and technology. The underweight in healthcare is almost all biotech. Biotech is a very big portion of the benchmark now. And that minus 6.6% relative weighting is after a couple months of work to ramp up our biotech weighting. So even with that, it's always an area we're going to be underweight. Consumer, that's, I would say, a pretty big overweight, more than we usually do. But as you can see, if you go back to some of these themes, outdoor leisure, trucking, like a lot of those fall into consumer. A lot of the housing names fall into consumer. So we at some point kind of have to go with just what the index says they are, even if we would want to debate it.
To piggyback on that, Mike, as what you said earlier, analysts and their kind of estimates and expectations coming out of Q1 just got so dislocated in the consumer industry specifically, or sector. And Ryan Isherwood, another on our team that Tope mentioned earlier, he really saw that and kind of got out in front of it and realized, hey, the Fed is funding this market, and this amount of liquidity is unprecedented. And so the dislocation between fundamentals was historic by any measure. And, especially in the consumer industry and also in the industrials, we saw it as well. You saw these decremental margins and the assumptions and analyst estimates. And so with decrementals, just your fixed costs are higher than when you take down your sales growth. So obviously your your operating leverage goes down inherently. So when your sales growth actually doesn't deflate, and these analysts were looking out 12 to 24 months because they look at everything so linear, you would actually see incremental leverage on the outside coming up with all this liquidity that came in. So when you take that decremental leverage that turned into operating incremental leverage, you just had this massive dislocation in earnings. And then to Mike's point earlier, you get this multiple revision because everyone was putting a cheaper multiple on the worst decelerating growth and operating decremental margins. So there was just this massive dislocation, especially in the consumer discretionary area. And that's why you see it so overweight. And it was a great performer for us too. And naturally, when you have an outperformer, it's going to become a bigger part of the portfolio.
Yeah, thanks, Kyle. These are just some fact sheets. Danny, I think you have this presentation. You guys can reference it, later if you want. We don't need to run through all of this, but something to maybe point out is if you look at that characteristics page in the top left, you can see we're higher growth than the index, right? 1 year sales growth in our portfolio is almost 20%. The index is 6%. Higher EPS growth, and it results in a higher multiple, 30 times PE ratio. Versus 22.6, but we think that's justified for the better growth that we're investing in. That's the market cap split on the bottom, and then there's the top 10 as of the end of Q2 on the right. There's just some more stats, kind of relative to what we've done versus the benchmark. This is on the right. You see the up market and down market capture. So basically in an up market, if the market's up, we're up, 1.19 versus that. But when the market's gone down, we're not down as much. We've only been down, 88 cents for every dollar that the market's down. So those are really strong numbers. To be able to outperform on the upside and the downside is something that has really resonated with some clients. Just another performance chart. This is rolling performance, and just a lot of times people get hung up on calendar year performance. So we've looked at rolling periods, and we think it's a better assessment of how we do. When I started, the calendar year performance wasn't very good. We had a large account that had a performance bonus that paid in August, and we got paid on that bonus every year. So it was just because of the way the calendar fell that our numbers didn't look that great. This is a way to kind of normalize some of that. Here are the actual return numbers. Again, you guys can, reference this later. How we rank versus the peers. Again, we've had a good couple years. So we've outperformed the benchmark, outperformed a lot of our peers over these times. We have a 4-star rating on our mutual fund on Morningstar. And then here's a couple stock examples. When we talk about looking for companies that can beat expectations, this is what we're looking for. You can see the blue dot is where sales expectations were for the quarter. The orange is what they actually did, and then you get the percentage of the beat. And this company in particular is actually showing more upside as time went along. A lot of times it's the opposite. If you think back to that chart, the curve is getting, the gap is getting smaller. So this is, we're seeing the beats get bigger, makes us realize we're still in the fat part of that curve, and we're not selling this stock anytime soon. Again, just another stock example, kind of looking at it the same way, and also on the bottom showing how the multiple expanded with the change in the estimates. So, and this is a slide showing, we don't just say that we try to find companies that beat expectations. We actually do it, and we do it better than the benchmark, and we have pretty much every year of our fund's existence. So with that, we're happy to take questions. Danny, I know you sent us some, you already have some, but if, feel free to fire away, guys, and if there's slides that go with it, I'll go back to them, or if not, Kyle and I are happy to talk about our experience and our background and our day-to-day.
All right, ask away, guys. Don't be shy. you guys don't have any, I have a list as well.
Yeah, why don't you just
Good question for Mike.
sure.
Can you hear me, Mike? Okay. So you said you own some stocks that don't have revenue yet. Did you ever look into Nikola? And what's your opinion on Nikola?
Well, Kyle, have you looked into Nikola?
Yeah, I was on a call with them yesterday, not directly in a management meeting, but just kind of on a fireside chat. It's harder for us, as Mike was saying with the biotech, similar to the EV theme. It's difficult if they're not having any deliveries. I think Nikola is more in like the back half of 2021 when they actually do start showing some deliveries. And, they're within that space, there could be several winners, and trying to estimate what that market actually is going to be relative to what the current market is, or the current TAM, and what that share of EV versus diesel or liquid natural gas is going to be is really hard. So it's kind of early for us. I will say we did play the EV theme in some other ways. There's other areas like last mile delivery that actually have some deliveries, no pun intended, or not to say it again, but that are going out to customers at this time, just because it's easier to do the electric vehicle when you're only going 50 to 75 miles a day. So no opinion on the stock.
Yeah, and the other, the ones that don't have revenue, it is some of the biotechs. You guys probably aren't all that familiar with drug development, but to develop a drug, you got to go from phase 1 to phase 2 to phase 3, and then approval and commercialization. The ones we own are only in that phase 3, or kind of waiting for commercialization. So the revenue is, probably within the next 12 months. And again, it's not a great fit for our process, but because of the benchmark, it being such a big weight, we can't ignore it, because it's, 15 to 20%, depending on if it's our small or mid cap benchmark, where like energy is, down in the low single digits now. So if energy goes up 10%, we probably don't really feel that in our relative performance. If biotech goes up 10%, we're going to feel that. That's one area where we probably do a little more, looking at the index, what's in the index, and just trying to not get blown up by biotech.
It's certainly a relative game, and that's probably misunderstood, or at least from my perspective before I came into working at Timpani and now Calamos. I always thought about things in an absolute perspective, but in this business, it's all a relative game. And ETFs and passive versus active, it is 100% relative. So you have to understand what your benchmark weightings are and be cognizant of what's going on within the benchmark.
All right, I'll chime in with a question. So you mentioned when you guys go through the process of looking at stocks, you first screen them, and then you actually physically meet with the companies. I'm just curious what that process looks like when you meet with the companies. Do you just speak with managers, or do you go out to physical locations and kick the tires, or what does that really look like?
For the most part, it's just talking to management. Usually we can get them on the phone pretty quickly, and especially right now with all conferences and things being canceled, we've been able to, we have an unprecedented amount of access right now, because we can attend all these conferences virtually that, a lot of times we didn't go to because, hey, maybe there are only a couple companies I want to meet with there. It's not really worth me going all the way to Boston for 3 days to do 2 meetings, right? Well, now I just click a link, same way I did for this, and I'm on with the management team, and I can do 2 of them from my desk. I didn't even leave my house, and I, can still go about the rest of my day. So we don't, if it's convenient, or if it's maybe a really big position, we would go on site. But for the most part, it's, an hour phone call here and there. That's kind of the extent of it. I mean, part of it is, not getting married to the stocks. If we go there and we see this unbelievable facility and think, oh, this was so great, I had such a great day at Nikola's headquarters, I'm going to be less likely to want to sell that stock than if it's just, this piece of paper to me and it's blown up, it's costing my clients money and costing us performance. Then, I'm, in my opinion, more likely to do what I think I need to do than to, come up with reasons to hold on to it because of this great day I had out at their headquarters.
It's not an absolute prerequisite either. There'll be times we initiate positions without meeting with management. Maybe we'll get a call in a couple months or a month later, and we'll try to initiate a position ahead of the meeting if we really like what we're digging into. But I'm not sure what the split would be from a percentage standpoint between the two, but it's a nice to have, not a must have.
Yeah, that's it. That's fair.
Any other questions for me, guys? I don't want to be taking all of them. Another question I have for you two is, how did you get into being a portfolio or equity analyst? And to people that might want to be an equity analyst later in their career, what would you recommend for them to do, and what would be a good process for them to go about doing that?
Yeah, I'll go first.
Mike took the more normal route.
Well, I'm not even sure mine was all that normal because not many people get a job on the buy side right out of undergrad. But
Fair.
I was, as Tope said earlier, I went to Marquette. I was part of the AIM program where we managed a portion of the endowment, and part of that was, you had to have an internship. Lucky for me, Marquette was in Milwaukee. The Timpani team was in Milwaukee, and they were looking for an intern. So I worked for them for a few months and then started full time after I graduated in May. And a lot of people go on the sell side first or some kind of investment banking route, and then maybe have to go back to business school and then try to get on the buy side. The way I looked at it is I could skip all those steps and save myself a lot of time and probably a lot of money. And if that was the job I wanted to do, why wouldn't I just do it right away? Like, why would I go through those other steps and then try to get onto the buy side? So I got a little lucky. They had an intern before me. She took a job in New York. So, if she doesn't do that, I never even get the chance. Kyle has a little bit of a different route. Maybe just, some other things I would add is, it's tough out there being part of the investment club and things. It stands out when we see resumes. I remember going on interviews and that I was already signed up for the CFA stood out to people. For us, the program was tailored to the CFA. So when I sat for level 1, 2 weeks after graduating, it was like an all-encompassing final, where some people try to do it a couple years after, and they're not in study mode. They're not used to taking a test. Then they struggle. It was, I don't want to say it was easy because it was a lot of work, but it was easier because of the way I did it. And maybe, Kyle had a little different path. So he share that with you.
Yeah, I didn't have any fancy internships in college. I played golf, so it was kind of set that I had to play golf throughout the summer. So I took kind of an accounting gig, in lack of better words, than mutual fund administration. But then, networking was critical for me. I met Ryan through golf, which I mentioned earlier, as a senior analyst on the team and portfolio manager as well, and was able to kind of move into Timpani in an operations role, and eventually ran our operations for a little over a year. And while I was running operations, I did have the fortunate kind of ability outside of that work to do fundamental analysis and kind of get caught up in understanding how to better analyze stocks and get familiar with the process. And, a lot of that was outside of the general 9-to-5 kind of business. Like, I don't know anyone kind of in our space or industry that works in 9-to-5. It's just not something you can do. And, I think networking and hard work are probably the two things that got me to where I am today, and hopefully where I go forward from here. But there's different ways to succeed in this industry. It's not always the smartest people in the room. There's intuition involved, and I think you have to trust your instincts, and you'll understand. And you have to be, somewhat lenient with yourself too when you're early. Like there's going to be blowups. You're going to be wrong. You have to understand and be willing to be wrong and learn from the mistakes. And so having a self-awareness, being good at networking, and working hard is really, I think, the three things for me that have helped me kind of evolve into the position I am today.
And maybe I'll just add one more thing on that. From my experience, like we had, like 25 students all looking to find a job at the same time. And we'd be competing against each other a lot and things, but the people that I remember struggling to find a job, just were the ones that weren't open-minded about it. It was like, I want to be a trader in Milwaukee. Well, it's like, well, there's only like 10 of those jobs, right? So to think that you're going to get one of those is just kind of unrealistic, or you're going to be, waiting or pounding on those all the time. You're lucky you're 22. You probably don't have, kids and stuff like like I got to deal with now. It'd be a lot harder for me to just pick up and move to New York or wherever for a job, where you can do that when you're younger. So, just keep an open mind and, just be willing to take a chance. I think that's something, that we did is, I could have worked at Mercer. I chose to work at a small startup in Milwaukee. I took a chance. It's easy to say when it worked out, but, somebody told me you could always go home if, it doesn't work out wherever you are. It's easy to move home. It's harder to move away. So be willing to be open to an opportunity, even if it's maybe not in the perfect situation that you envisioned.
Piggybacking off of Danny's question, what abilities and skills would someone need to succeed in this field?
I can start. I think you need an analytical and a curious approach in your mindset. I mean, we're looking at the best part about our process and what I enjoy the most is I'm not looking at the same stock on a day-to-day basis. We're not writing 2-week-long research reports that are 25 pages. We're digging in and we're doing the work, but we're not getting into the weeds of trying to move every little estimate and every little growth rate around to get an extra penny or two in the earnings model. Like, that's just not what we do. We take more of a shotgun approach. So I would just say, I think you have to be, again, what Mike said too, is open-minded. I had no idea I would be a growth analyst or like growth. Like in school, I imagine your finance classes, they're all tilted towards value, right? Like everyone's taught discounted cash flows and, we're really not doing a whole lot of that. And there are other opportunities and different ways to invest. And that's something that I don't think is really taught in finance school. And so I think just being curious and being open-minded is really key.
Yeah, those are definitely things that we look for, and just, even though you're in school, I mean, what are you doing about now? Do you guys write reports for the investment club, or are you investing money on your own? It's easy to sit there and write on a resume or an application that you care about something, but what are you actually doing? That speaks volumes. Taking a Tuesday night out of your time to listen to Kyle and I talk, that shows something. And especially now, like it can sometimes be a little overwhelming to hear somebody like me say, well, are you investing on your own? On most of these sites now, you can buy fractional shares. You can, put $5 here and $10 there. It doesn't require thousands of dollars to get started. Try it out. You're going to learn more doing it on your own than you'll probably learn, an entire semester in class. You'll see what you gravitate towards and you think your process is, and, that'll help you know what you want to do.
Another question. You guys kind of mentioned how from like where you started in college to where you are now? Do you have anywhere else you want to be? So any other positions you might want to have, any other dreams in your career that you want to accomplish before eventually you retire?
You want to start, Kyle?
Go ahead.
I think, I think for most of us, the goal at the end is to, actually be the one pulling the trigger and, running the portfolio. Right now, the way our team is set up, Brandon Nelson, the portfolio manager, he has all the buy and sell decision-making power. Kyle and I give him recommendations, and he acts on those the majority of the time. But, at the end of the day, it is still his decision. And, we do disagree on things occasionally, but given that all of us have kind of been born and raised in this process and don't really know anything other than this team, the disagreements don't happen that often because, I don't bring him something I know he's not going to buy. And, I very rarely push a sell idea that I don't think he's going to do. So, that'd be the goal. But the other dynamic of that is Brandon's our portfolio manager. I mean, he's not even 50 yet. Like, it's not like Brandon's retiring anytime soon. So, we'll just have to see how that plays out. I think for now, the goal for our team is just to keep putting up good numbers and manage more money and, become a bigger piece of Calamos and show them they made a good decision acquiring us a little over a year ago.
Yeah, I would second everything Mike just said. It's, the goal from a portfolio manager or kind of operating your own shop, and Tope, close your ears on that one. But so it's the natural progression through the industry, right? As research analysts, senior research analyst, co-portfolio manager, portfolio manager. And, that has to be the goal. I think but to Mike's point, I would agree. It's, near term, we're more focused on bringing in assets, continuing the performance we've had. And, that's in this industry, compensation comes from bringing in assets, performance, and also your firm's performance, and simply put, the absolute performance in the market. So there's several different ways that compensation works in this industry. And I think that's the near-term driver is, I think, compensation. And just if you like this business, I think you have to like money and succeeding for yourself. So that's the near-term driver.
All right, we probably got time for one more question. We don't want to take up too much of their time. So if anyone has another question, just feel free to shout it out.
Here, I got one, I guess. So earlier, you guys were talking about finding undervalued stocks in the markets that will like exceed the expectations that are on them. And I was trying to see like what your thoughts are on speculating versus investing in a stock, and where you really draw that fine line, where you're really investing rather than speculating on a huge growth.
I think I would look at speculating as, if we were just buying them blindly off the screens, that'd be more speculating to me. Where, just because something shows, again, something shows up on our screens, we don't just buy it. We analyst reports on it. We read the quarterly or annual filings. And, that's where our research process starts, is when it shows up on the screens, or, like I said, the opposite before, like we've already met with management, then it shows up on the screens, and then we're already good to go. But maybe, I don't know, Kyle, if you have a different.
No, I think that sums it up perfectly. We've never recommended a stock just simply from being on the screens or just seeing it break out from a 52-week high. And a lot of times we are buying stocks that are at 52-week highs, which is very unusual to kind of the general investor or standard kind of thought process and fundamental or equity analysis. So there is fundamental rigor, and as you can see, it's 70% of our process, or 70% of our screens, if you will, and 30% would be more technical, kind of market sentiment based.
Hey guys, I recall you mentioning one time to our group that you guys will typically not invest in a stock that's not being followed by at least one major analyst. Would that also speak to the lack of kind of taking that speculative route? And then also, you guys cover companies at the highest level, $4 billion. So within that range of companies, what would you say is the biggest focus in terms of the average market cap that you guys are focusing on? Because I think the speculation could come from those companies that are in that hundreds of millions of dollars market cap range, right?
Yeah, definitely. It's not a requirement that there's an analyst, but it's definitely preferred and strongly preferred, and that might not even be putting it strongly enough. But that's the way we measure market expectations is by using the sell side consensus. So if there's no analyst, there's no consensus. So we don't have anything to measure it against. And that's why, if it doesn't have coverage, there's a reason it doesn't have coverage. So that, in and of itself probably makes it more speculative. On the market cap size, we say we'll go down as low as 150 million. And, but each situation is unique. If just because something's 2 billion doesn't mean we're going to buy it. And just because something's 125 or 125 million doesn't mean we're not going to buy it. A lot of that comes down to liquidity, and sure, maybe it's only 125 million, but it just came public. I'm thinking of Fathom, Kyle, that we bought pretty recently. Like, we knew there was analyst coverage coming. It was small, but we had a meeting with them. So there's, I guess, always shades of gray with some of that. It's hard to draw just a fine line, but 150 is what we say, but there's always exceptions.
Awesome. We'll end it there. I don't want to take up too much of your time.
Anything, Danny?
Greatly appreciate it. Quick shameless plug. I noticed we have some people in here that aren't in the investment club. So if you're interested in joining, just send me an email. But I'll just end it there. I'll stay after if you have any questions or you want to talk about anything. But Tope, Mr. Klenn, Mr. Kolberg, thank you so much for your time. We greatly appreciate you taking time out of your busy day to speak with us. And it's been very insightful. So thank you so much.
Thanks, guys. Good luck.
Happy to do it. Thanks for having us, Danny.
Okay, guys.
Have a good night.
Thank you, guys.
Thank you.
Thank you.